Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.
Hello and welcome to Nirmal, ladies and gentlemen. I'm Hiral Dadia. We have with us Mr. IV Subramaniam, MD at Quantum AMC, joining in. Welcome to the show, Mr. Subramaniam, and a pleasure to speak to you as always. Mr. Subramaniam, with the kind of corrections that we are seeing in the domestic market and the quantum of liquidity infusion that we are seeing with the global markets, how would you actually describe and view the setup right now?
So it's MD at Quantum Advisors, which is a SEBI registered portfolio manager. So from a market's point of view, two things impact the markets, right? One is the way economy is shaping up and therefore what is the expectation on earnings growth. The other is the sheer availability of liquidity. So at this point in time, when you look at the fundamentals, when you look at the economy, when you look at what the companies are saying, definitely there seems to be a lot more activity this year than we had last year. And things are looking better from a company's point of view. Of course, there is an inflation pressure in terms of raw material costs moving up, and some of the costs which people were able to cut down last year, let's say travel, advertising, budgets, etc. Some of them may come back. While the earnings growth would still be good, but maybe the margins will not be as rich as it was in the last two quarters. But having said that, because the earnings growth is likely to be good unless we have this second wave of virus impacting us again, I think that's a positive news. So the economy is doing well and earnings growth is likely to be good. And banking non-performing loans also should be within reasonable levels. So that's on the positive side. But if you look at the flows and the valuations, definitely on a PE basis, if you look at the Sensex, it does look rich because remember in the first quarter of last year or first quarter FY21, we had the GDP collapsing and therefore earnings collapsing. And therefore the PE ratios look a lot more richer. Even if we adjust for that, the flow of money has ensured that the in general valuations look a little expensive. But then the flow of money can continue. There are enough reasons to think that India is relatively better placed in terms of growth. And if you look at the trigger points, whether it is in terms of low interest rates driving real estate demand, and that in turn having an impact on many other sectors, it looks like the flow may continue for some time. So my end conclusion is it's always easy to take a call on how the macro is shaping up, but very difficult to say how flows would sustain or not sustain. So bear in mind that much of the flows which have come into India in the entire calendar year 2020 has also come from people who have just allocated to India. It's part of the emerging market fund, or it is part of a global fund. It is not necessarily coming from people who have a very sound understanding of India, right? So to that extent, there is a risk. If tomorrow something happens in India or some sort of fear comes in, some of that FPI money could flow out of India. So I can only tell you the risks which can come from an FPI flow where stock prices may go down. But how exactly it will shape up through the year, we will not be able to predict. India looks good on a relative basis, so flow should be positive. But because there was a very large amount of money which came in last year, there is always a risk that some of that money could go out and stock prices may go down for some time before it bounces back.
Right. So, Mr. Subramaniam, that's on with regards to how the flows are going to pan out for India. However, one thing that we witnessed is when the FI flows were positive, there was a lot of redemption that happened by mutual funds. However, the retail participation did increase in the country. Do you think even if FI money still flows out, will domestic investors be the support for the market, which could take markets higher from here on?
It can be a support to the extent that it may not allow it to come down very rapidly. Because even on the domestic side, between people who invested, let's say, in the last 5 6 years, uh, as the markets hit 50,000, many of them are seeing that their NAVs have also gone up, and there has been some sort of rotation or redemption out of equity funds by a lot of retail investors. But if the markets were to correct, and if the communication from the mutual fund industry is that the equities in the long run will still be good, and people understand that, you may see some of that flows coming back into the markets from the retail investors. So net, it's not going to be 1:1. If the FPI sell very aggressively, you will find markets declining, but you may also find some support level coming up at a certain level where people feel comfortable with investing. But very difficult to say at what could be that level. But given that Indian retail investors are still very, very under-owned when it comes to equities, there is still a large room for a lot of retail money to come into the Indian markets.
Right. So with this, do you think someone should worry about falling markets right now, or do you think falling markets is going to be an opportunity to invest?
No, falling markets could be an opportunity to invest, but from a retail investor's point of view, you have to have a sense of what's your allocation. You need to have a sense of why are you investing, what is your time horizon for the investments, and then take a call. It should not be based on whether the markets are coming down or going up. You cannot take a call on that. I think you clearly have to have a good understanding as to for how many years you plan to remain invested, what is your risk appetite, and then based on that asset allocation, you can remain invested, or you can increase your investments.
Right. And Mr. Subramaniam, right now, if you were to see, there are concerns on both ends, domestic and the global front. We are seeing a spike in terms of COVID cases in India. There have been announcements of lockdowns in several districts. With this, bond yields in the US and the domestic market are rising. How would you actually see markets performing from here on? What are the kind of risks associated with it? Uh, if we are supposed to see a negative annotation, and if markets could see a big correction, what quantum of correction could be on the annual?
No, rising yields are always a um, uh, sign that financial assets could decline. If you just as a lowering of yields last few years saw an increase in the value of financial assets, value of equities. Similarly, a rising yield could have an impact on equity prices, and it could decline. Again, we do not take a view on the markets, so I cannot tell you how much it will decline. I'm just giving you this idea that a rising yield will always mean that financial assets, and even including equity prices, could decline. But how much it will decline, we can never say that, because even on a relative basis, in terms of growth, India still looks good. So despite the rising yields, there may still be some amount of money which could flow into India. So these are areas where we cannot exactly pinpoint and say that this will happen. Nobody expected last year that this kind of FPI flows would come into India, at least at the start of the pandemic. We did know that governments will take action and some of that money could come into India, but the proportion of money which came into India was something which I think surprised many people in the market. So similarly, if the yields rise, it will have an impact. How much we cannot say, but be ready, as we have always said to retail investors, that be ready with your plans, be ready with your risk appetite. And if you are an SIP investor, you can always take advantage of investing in lump sum whenever the market declines to a level where you are comfortable investing. But your approach to the market should always be based on your risk appetite, time horizon, what kind of funds you would like to own, and not the level at which the market is operating.
Right. So overall, if you go to see, do you think history could repeat itself, which is that you buy some of those COVID hit industries in the peak of pessimism, that when things start normalizing, these stocks will come back. Do you think the rise in COVID cases is a good time for a long-term investor to buy into a stock, say, the hotel industry, which has been hit, the tourism industry, which has been hit.
You have to look at the valuations. Like I can tell you what we do at Quantum. For us, valuations at the end of the day is the most critical factor. So while we will evaluate the company's fundamentals, we will talk to the management, we will understand their long-term strategy. But at the end of the day, the valuations is what will decide whether we have to remain invested or not. So yes, if COVID-related cases result in certain sectors becoming cheaper, and the long-term picture of that industry still looks good, one can go ahead and invest in those sectors.
Right. And clearly, right now, if you go to see, majority of the up move initially was led by large cap companies. Now you're seeing an up move that's coming in terms of mid cap and small cap counters. According to you, where are you seeing value? Where do you think there is more value on risk reward basis?
I wouldn't look at it from a market cap basis to see where there is value.
Hmm.
From a sectoral basis is where we can understand what is in general happening. So barring, I think, IT, information technology stocks, which seem to have become, which have run up so much that it seemed to have become a little expensive. But apart from that, if you look at most of the other sectors, whether it is banking or consumer discretionary, I think there is still good amount of steam left in these sectors. Now, which company, what kind of fundamentals suit you? Those are things which every investor who wants to invest directly would need to do their own homework. At Quantum, for us, the stock has to be very liquid, which means it has to trade at around 7 crores or 7.5 crores a day. Second is the valuations have to look attractive. The market cap doesn't really matter to us, whether it's large cap or mid cap.
Right. And from this as well, overall, if you go to see from here on, taking India's growth into consideration, do you think we are entering a period of a virtuous growth cycle, and you will have that actually, what the companies will be imitating as well, especially the ones who will be seeing this kind of growth?
Sorry, on the last question, what was it on the companies?
No, I'm saying, do you think that India is entering a period of a virtuous growth cycle? And it's the small and the mid-sized companies who will outpace their large cap peers, taking this growth into consideration.
No, so India has always been a potentially growing country, right? The potential to grow is humongous. You look at any product where we are so underpenetrated that there is a reason to believe that India will continue to grow very rapidly. But there will always be cycles. There can never be a virtuous cycle which will only grow. Right from you go back even in recent history as 2005, 6, 7, when brick as a concept was very popular. They said India, Brazil, Russia would all continue to grow very well. But then every economy will also have cycles. There will be periods of slowdown as we have had in the last few years. It was led partly by banking, partly by certain policy changes. You did see the economy slowing down, but that doesn't mean that India will stop growing. It will grow. Certain periods it may grow at 7.5% real GDP growth. Certain periods it may grow at a much lower period. So growth is I think we have to assume that India will grow. And as an equity investor, you have to believe in that kind of growth because you are by nature an optimist. So you would think that India would continue to grow and there would be opportunities. Now, between mid cap and small cap, the only caveat I would say in recent times has been that in every large crisis, the large cap tends to benefit much more than the mid cap and small cap. So if you look at CMI data also, it looks like a lot of those mid-sized companies were more seriously impacted due to COVID, right? The supply disruptions, not able to attract employees, labor-related disruptions, and they still continue to be a challenge. So while technically the growth rate of a smaller company could be faster than a large company, but at this point, it looks like there is consolidation happening and larger companies seem to be benefiting compared to the mid-sized companies. So you have to keep that in mind if you are looking in terms of where to invest. that it appears at the ground level it is more favorable for large companies today than it was some time back.
Right. And very lastly, Mr. Subramaniam, do you think rising yields is going to be a worry? Because there is some bit of nervousness in the bond markets. And that's clearly seen in the sharp rising commodity prices, especially the way crude has reached $60 a barrel. The equity rally, which has actually started in April 2020, is basically saying that, yes, there is a lot of liquidity infusion that's coming in. But do you think there is a possibility of a significant correction that could come in if the rising yields continue?
Yeah, I think I answered this earlier also that I cannot predict the market. All I am saying is if lowering of yields pushed up stock prices, a rising yield can also bring it down. Now, how much and on a relative basis between India and US will those changes result in declining prices? We will not be able to say how much it will decline. But a rising yield will always mean that it has become a little more expensive for people to leverage and invest. It just means that the cash flows of every company will have to be discounted at a higher yield, which means the current value will go down, and therefore the prices could definitely decline. But how much we will not be,
Mhm.
we cannot tell you about this.
Absolutely, absolutely. All right, Mr. Subramaniam, thank you so much
Thank
for
you.
sharing your views. It was a
Thank
pleasure
you.
to have you. Stay safe and thank you so much.
Thank you.